William Gann, a legendary figure in financial markets, firmly believed that time, not price or volume alone, was the ultimate determinant of market movements. His profound insights into cyclical patterns revolutionized how many perceived trading, emphasizing that understanding the temporal rhythm of the markets is paramount for success. Gann posited that specific periods exist when markets are particularly vulnerable to significant shifts, turning points, or accelerated trends, making these times either incredibly opportune or catastrophically dangerous. For any serious trader, grasping these critical junctures and the underlying psychological pitfalls is not merely an advantage but an absolute necessity for capital preservation and profit maximization. This exploration will unveil 3 deadly times that, according to Gann's timeless principles, every trader absolutely must avoid to safeguard their capital and significantly enhance their trading profitability. Ignoring these warnings is akin to navigating a minefield blindfolded, often leading to avoidable and substantial losses. The first deadly time for any trader, as articulated by the profound wisdom of William Gann, involves actively trading around or worse against the critical turning points identified by his intricate time cycles. Gann's extensive research revealed that markets are inherently cyclical, mirroring patterns found in nature and history, suggesting that certain temporal periods are predisposed to major reversals or significant trend accelerations. To disregard these historically validated periods is to open oneself up to potentially catastrophic trading outcomes, as the market often adheres to these powerful underlying rhythms. Understanding these cycles is not about predicting the future with absolute certainty, but rather about recognizing periods of heightened risk or opportunity where market behavior can become exceptionally volatile and decisive. One of the cornerstone methodologies within Gann's framework involves the meticulous observation of seasonal dates and astronomical points, which he identified as powerful potential market turning points. He meticulously documented how the equinoxes occurring around March 21st and September 23rd, along with the solstices, typically on June 21st and December 21st, often coincided with significant shifts in market direction. These dates, marking the change of seasons, were not merely arbitrary calendar entries for Gann. He saw them as reflecting deeper cosmic and psychological influences that could profoundly impact collective market sentiment. Traders who fail to acknowledge the historical tendency for markets to react around these pivotal astronomical moments risk being caught off guard by unexpected reversals. Beyond the major seasonal shifts, Gann also highlighted the importance of what he termed cross-quarter dates, which fall approximately midway between the equinoxes and solstices. These dates typically occur at the beginning of February, May, August, and November, and Gann observed that they too could act as significant periods for trend changes or accelerations. These specific points on the calendar, though less widely recognized than the equinoxes and solstices, carry a unique weight in Gann's analytical framework, representing additional layers of cyclical influence. A trader who is unaware of these specific time markers might inadvertently place trades just before a significant market pivot, turning a potentially profitable setup into a rapid loss. Gann's understanding of market cycles extended further into a nuanced appreciation for shorter and medium-term cycles, which he observed recurring with remarkable consistency across various time frames. He meticulously tracked cycles of 7, 45, 90, and 144 days, weeks, or even months, noting their propensity to mark important shifts in market sentiment and trend direction. For instance, the 7-period cycle, whether 7 days or 7 weeks, often denoted periods where corrections or minor reversals were likely to occur, sometimes referred to as a zone of death for unsuspecting traders. These cycles, when combined with price action, provided potent signals for anticipating market behavior. The significance of these specific cyclical durations lies in their ability to pinpoint moments when the market's underlying energy shifts, making them periods of heightened volatility and potential trend alteration. A trader who ignores these recurring temporal patterns might find themselves holding a position that was previously profitable, only to see it rapidly erode as a new cycle begins to assert its influence. Gann's work was replete with examples demonstrating how markets would often respect these time frames, leading to predictable reactions around these points. Therefore, understanding and monitoring these shorter and medium-term cycles provides a crucial layer of defense against unexpected market movements. Furthermore, Gann placed considerable emphasis on the concept of anniversary dates, recognizing that the anniversaries of important historical market highs and lows often served as potent potential turning points. He believed that significant past events left an energetic imprint on the market, and that these anniversaries could trigger similar psychological reactions or structural shifts. For example, if a major market top occurred on a specific date in the past, the anniversary of that date in subsequent years could act as a resistance level or a point where momentum might reverse. This concept underscores Gann's belief that history, especially in its temporal dimension, tends to repeat itself. The danger in ignoring these anniversary dates is that traders might fail to recognize the powerful psychological and structural memory embedded within the market. Entering a trade without considering if it aligns with an important historical anniversary date means overlooking a potentially strong signal for a reversal or a continuation of a prior trend. Gann urged traders to maintain detailed historical charts and calendars, marking these crucial dates to anticipate periods of heightened market sensitivity. His approach was never about blind prediction, but about preparedness and recognizing probabilities based on historical temporal patterns. Trading against an expected reversal during these identified critical time periods, or failing altogether to recognize the potential for a significant shift in trend, can indeed be catastrophically deadly for a trader's capital. The market, when it reaches these cyclical junctures, often moves with swift and decisive force, punishing those who are out of sync with its underlying rhythm. A position that seemed robust moments before can quickly turn into a substantial loss if one is caught on the wrong side of a Gann-identified time-based reversal. This highlights the absolute necessity of integrating time analysis into every trading decision. To effectively avoid the pitfalls of this first deadly time, Gann advocated for the diligent use of what might be termed a Gann calendar. This is not a simple datebook, but a meticulously maintained record where all the critical dates, equinoxes, solstices, cross-quarter dates, significant cycle endings, and historical anniversary dates are marked well in advance. The purpose of this calendar is to create a constant awareness of when the market is entering a period of heightened sensitivity. However, Gann also stressed that these dates are not standalone signals. They must always be confirmed by concurrent price action, volume, and other analytical methods. The second deadly time that William Gann vehemently warned against involves trading in markets characterized by an uncertain trend, or, equally perilous, those exhibiting low activity and muddled price action. Gann's trading philosophy was built on the premise that clarity is king, and entering trades when the market's direction is ambiguous or its momentum is lethargic is an invitation to unnecessary risk and often inevitable losses. He understood that true opportunities arise from clear, decisive movements, not from the chaotic noise of indecision. This principle remains as relevant today as it was in his time. At the core of Gann's cautionary advice lies the immutable rule: never go against the trend. This principle is not merely a suggestion, but a fundamental tenet of successful trading, particularly crucial when the trend itself is unclear. Gann emphasized that attempting to enter a trade when the market's direction is ambiguous, let alone actively trading against a perceived trend, is a perilous endeavor. Such actions are often driven by impatience or a speculative urge to catch the top or buy the bottom, which Gann recognized as incredibly dangerous and consistently unprofitable strategies. These attempts to defy the prevailing market forces rarely end well. The market, when devoid of a clear trend, behaves erratically, often chopping sideways within a range, generating numerous false signals that can entrap unwary traders. Gann understood that trying to profit from such indecisive movements is akin to gambling rather than strategic trading, as the probabilities of success are significantly diminished. He counseled patience and discipline, urging traders to wait for the market to reveal its true direction before committing capital. Without a clear trend, any trade is essentially a guess, lacking the statistical edge that disciplined trend following provides. Gann also placed immense importance on the necessity of trading only on active markets, those characterized by high volume and a clear discernible momentum. Active markets, by their very nature, tend to exhibit cleaner price action, making technical analysis more reliable and entry-exit signals more robust. High volume indicates strong institutional participation and conviction, which often translates into more sustained movements and less erratic behavior. Conversely, markets with low activity are prone to sudden, unpredictable spikes and drops due to thin liquidity, making them exceedingly difficult to analyze and trade profitably. The danger of trading in inactive or thin markets is multifold. Such markets are susceptible to manipulation, wide bid-ask spreads, and poor execution, where a trader might not get the price they expect. Furthermore, the lack of consistent volume often leads to choppy whipsaw price action that can trigger stop losses prematurely, even if the underlying trend eventually materializes. Gann observed that true sustainable moves are always accompanied by significant activity, providing the necessary fuel for price progression. Therefore, focusing solely on active markets is a critical filter for identifying genuine trading opportunities. While not explicitly termed a deadly time, the absence of a clear trend, often manifesting as sideways or flat movements, renders such periods exceedingly risky for trading using Gann's methods. His techniques, particularly those involving angles and squares, are designed to identify and capitalize on trending markets. When the market is moving horizontally, these powerful tools lose much of their predictive accuracy and utility, making any attempt to apply them fraught with danger. Traders who insist on trading during these flat periods often find themselves battling against unpredictable price oscillations. The inherent deadly nature of trading in markets with uncertain trends or low activity stems from the fact that uncertainty directly fosters random, undisciplined trading decisions, which almost invariably culminate in losses. When the market lacks a clear direction, traders are more likely to chase fleeting movements, overtrade, and abandon their trading plans, all of which erode capital. Furthermore, sluggish markets, characterized by low volume and indecisive price action, are notoriously difficult to analyze accurately, making them breeding grounds for frustration and poor judgment. The market's noise overwhelms any potential signal in such environments. To effectively avoid this second deadly time, Gann's teachings emphasize the paramount importance of disciplined patience and rigorous trend confirmation. Traders must cultivate the mental fortitude to wait for the market to unequivocally reveal its direction before committing any capital. This means employing robust trend-following indicators, observing volume patterns, and ensuring that multiple analytical tools confirm the presence of a clear, actionable trend. Only then, when the market is actively moving with a discernible direction, should a trade be considered. This disciplined approach minimizes exposure to random market fluctuations and maximizes the probability of successful outcomes. William Gann's seminal work, Truth of the Stock Tape, stands as an enduring testament to his profound understanding of market dynamics, delving deep into the very cycles and psychological underpinnings that govern speculative activity. While the book offers unparalleled insights into market behavior, psychological traps, and the importance of time, it's crucial for modern readers to approach it with a specific awareness. The original historical charts, though invaluable for Gann's analysis, are frankly of very poor quality and can be quite challenging to decipher in their raw form. However, this does not diminish the timeless value of Gann's written principles and his deep dive into the human element of trading. Studying this classic is an essential step for anyone serious about mastering the market's subtle rhythms and understanding the psychological warfare that takes place on the trading floor. To truly grasp the essence of Gann's wisdom, you need to engage with his original thoughts, even if it means interpreting the charts through a modern lens with better visual aids or interpretations. You can find Truth of the Stock Tape and begin your journey into Gann's mind by checking the link in the description below. The third and perhaps most insidious deadly time, according to William Gann, is not a specific calendar date or market condition, but rather the internal battle waged when trading decisions are driven by raw emotions and a blatant disregard for sound risk management principles. Gann unequivocally stated that emotions such as hope, fear, greed, and ego are the primary adversaries of any trader, consistently leading to irrational choices at the most critical junctures. These psychological traps can dismantle even the most meticulously crafted trading strategies, turning potential profits into devastating losses. Mastering one's own mind, therefore, is as crucial as mastering market analysis. One of the most fatal errors driven by hope and ego is the practice of averaging down on a losing position. Gann considered this a fatal mistake, a desperate gamble fueled by the irrational hope that a losing trade will eventually turn around. Instead of cutting losses quickly, traders often add to their positions as the price moves further against them, transforming a small, manageable error into a potentially catastrophic capital drain. This emotional attachment to a losing trade prevents objective decision-making and often leads to an uncontrollable spiral of increasing risk. A disciplined trader accepts small losses as part of the game rather than clinging to a dying hope. Gann also sternly cautioned against the detrimental habit of overtrading, which involves entering and exiting the market too frequently. This behavior is often a symptom of impatience, a relentless desire for quick profits, or an inability to sit on one's hands and wait for high-probability setups. Overtrading leads to excessive transaction costs, increased exposure to market noise, and a rapid depletion of mental and financial capital. It's a clear sign that a trader is allowing emotion, specifically greed or a fear of missing out, to dictate their actions rather than adhering to a carefully constructed trading plan. Quality of trades always trumps quantity. A critical principle for preserving capital and ensuring long-term profitability, as emphasized by Gann, is the absolute necessity of never allowing a profitable trade to transform into a losing one. This requires the disciplined use of protective stop losses, moving them to break even or trailing them behind the price as a trade moves into profit. Many traders, fueled by greed or complacency, fail to protect their gains, watching in dismay as a winning position reverses and ultimately turns negative. This emotional reluctance to lock in profits, even partial ones, is a common pitfall that Gann warned against, stressing the importance of protecting what the market has already given you. Gann also highlighted the destructive pattern of taking small profits while allowing losses to run large. This imbalance, often driven by fear of losing profits and hope that losses will reverse, is a sure path to trading failure. Successful trading, according to Gann, demands the inverse, allowing profitable trades ample room to develop and grow while ruthlessly cutting losses short. This fundamental asymmetry ensures that when you are right, you profit significantly, and when you are wrong, your capital erosion is minimal and controlled. It's a cornerstone of positive risk-reward management that emotional trading often undermines. Furthermore, Gann warned against the subjective and often baseless practice of buying or selling an asset solely because its price appears low or high. This emotional judgment, devoid of any objective analytical confirmation, is incredibly dangerous. What appears low could plummet further, and what seems high could continue to rally significantly. Gann insisted that trading decisions must always be substantiated by robust analytical methods such as his time cycles, price patterns, and volume analysis, rather than relying on a subjective perception of value. Emotionally driven price judgments bypass all rational analysis. The deadly consequences of trading driven by emotions and poor risk management are profound and ultimately lead to the systematic destruction of a trader's discipline and inevitably their capital. Emotional decisions bypass logical reasoning, leading to impulsive entries, delayed exits, and an abandonment of any predefined strategy. This self-sabotaging behavior ensures that even when the market presents clear opportunities, the emotional trader is ill-equipped to capitalize on them, instead falling prey to their own psychological vulnerabilities. Gann understood that the battle for trading success is first and foremost a battle within oneself. To effectively avoid this third deadly time, William Gann prescribed a rigorous approach centered on developing a robust mental fortitude and unwavering adherence to a meticulously crafted trading plan. This involves cultivating discipline, patience, and emotional detachment from market fluctuations. The consistent use of stop losses, set logically and not emotionally, is non-negotiable for managing risk and protecting capital. Crucially, all trading decisions must be predicated on objective analysis and the established rules of a personal trading plan, rather than succumbing to the fleeting whims of hope, fear, or greed. This disciplined, logical approach is the bedrock of sustainable trading success. In summary, William Gann's timeless principles offer profound warnings against three distinct, yet interconnected, deadly times that every trader must diligently strive to avoid. First, trading around or against critical time cycle turning points, such as equinoxes, solstices, cross-quarter dates, and anniversary points without confirmation, exposes traders to sudden and powerful market reversals. Second, engaging in trades within markets characterized by uncertain trends or low activity is a recipe for random, unprofitable outcomes, as clarity and momentum are paramount for effective analysis. Finally, and arguably most critically, succumbing to emotional decision-making and neglecting sound risk management principles, such as averaging losses or overtrading, will inevitably erode capital and destroy trading discipline. Gann's legacy is a powerful reminder that true success in the markets is achieved not merely through identifying profitable opportunities, but equally, and perhaps more importantly, through a rigorous avoidance of predictable pitfalls. Integrating his insights into time cycles, disciplined trend analysis, and unwavering psychological control into your trading strategy is not an option, but a fundamental requirement for anyone aspiring to consistent profitability. By understanding and actively sidestepping these deadly times, traders can significantly enhance their chances of preserving capital, growing their accounts, and ultimately achieving stable, long-term success in the dynamic world of financial markets. Continuous learning, self-reflection, and the unwavering application of these enduring principles are the true keys to unlocking your full potential as a trader, transforming uncertainty into a strategic advantage, and emotional traps into controlled opportunities. For those fascinated by the rich history of financial markets, the legendary figures who shaped Wall Street, and the dramatic narratives of financial crises, there's a treasure trove of content waiting for you. The Wall Street Memoirs channel delves deep into the historical events, the pivotal moments, and the remarkable personalities that have defined the financial world through the ages. It's a perfect complement to understanding the historical context and recurring patterns that figures like William Gann observed. Dive into captivating stories that illuminate the past, providing context for the present and insights into the future of finance. You can explore these compelling narratives by visiting the Wall Street Memoirs channel linked in the description below.